in the banking system, oh man, I don't know how to like. Basically, he was trying to explain to me how when banks intertwine with each other, when JP Morgan transfers $1 billion worth of liabilities to Chase, and then they have to send the offsetting assets, they only send those because of there's rules to send them. If Chase and JP Morgan just decided, oh, you don't have to send me $1 billion worth of assets, I'll just take the liabilities, then there wouldn't have to be any offsetting asset. It's purely, the Monte system is strictly the way it is because everyone trusts each other and says that it is the way it is.
Confidence.
But yeah, exactly. And then with the central bank, they wouldn't have to have any of that trust, besides, unless, at least not an onshore dollars. But if offshore dollars started to lose faith and they didn't want to take them, especially because we don't produce any goods, then that would be a different story.
I think so. My takeaway from all that was, because I was watching the video in real, maybe like 5 minutes late, basically real time, is that the Achilles heel of the current system is that banks, all you need is one bad actor in the banking sector to take down the entire thing. You know how like Nanarino talks about everyone just like did a run on one bank, whatever, that would collapse the entire system. So there's that. And I would also note that if you go to one singular system, FedCoin or whatever, right, you suddenly can't have any more bad actors. It's just the one entity, and why would the one entity collapse itself, for example? So
well, they can't collapse itself because if the central bank gives $1 billion loan, there's no other, they're not going to have to deposit an asset anywhere. The only reason why banks can't create unlimited money is because when they transfer those liabilities to other banks, then they have to send an offset an asset. But if there isn't another bank to set an offset an asset to, then they can create unlimited money without having to have any restraints of the quote unquote rules.
Right, but wouldn't you say that that's already the situation that banks are in? Or back up.
I would say no.
Let me
because, okay.
Yeah, I'm just proving one caveat. As long as the banks retain confidence in their peers, there's technically no.
Well, no, I would say no, because if I transfer $1 billion to you and we're both banks, $1 billion worth of liabilities, you also have to pass on the $1 billion worth of assets. So you have the restraints where you need those assets to transact with other banks. If you don't have the assets, then you would be insolvent, and you'd be insolvent because everyone else collectively believes you're insolvent. On the other hand, if it's the central bank if there's only one bank, then the central bank can issue as many loans as it wants, and there doesn't have to be any offsetting assets, because they're not going to transfer $1 billion worth of liability to someone else where they have to also translate an asset. They can have negative equity and count the loan as their asset, which I think the big difference is.
Okay, right. So I don't agree with that, but let's go back to the point with banks interacting with other banks. Okay, basically what's going on is, remember, Gannon was talking about using gold as final settlement. So said another way, if banks indefinitely postpone settling up with other banks, one bank might be the bag holder of another bank. So for example, one bank might say, okay, well, listen, technically we're due, I don't know, like $1 trillion, or we're due like $10 billion from Bank of America, or whatever, right? But we think Bank of America is good for us, so we're just going to let it ride and eventually, come back down. That's why I remember the confidence thing, because as long as that confidence boundary isn't breached, I actually think the numbers can go up as high. I don't think there's any upward limit on that regard. Because let me say this a slightly different way. If the bank, I send you $1 billion at your bank gives you the credit in your account, so you now have $1 billion that you can spend. And your bank is now waiting on my bank to remit $1 billion of assets to back up the liability they have on the balance sheets, which is your asset. Right? You with me? Mm-hmm. Right? Josh?
Yeah.
Okay. So if your bank has an unlimited amount of trust in my bank, technically my bank wouldn't necessarily have to ever do the final reconciliation. They could just keep saying, okay, well, here's another $1 billion for Lassard, another $1 billion, another $1 billion, another $1 billion, or whatever, right?
Yeah.
Okay. So I think that this is the difference. This is, I think, the key difference between the one mono central bank and then the multiple individual banks. I think both systems actually can issue an unlimited amount because there's no final, or both systems can postpone final reconciliation indefinitely. But with the multiple bank system, they can only postpone final settlement if every other single bank.
Yeah, and that's never going to happen. That's I would argue every single bank is never going to collectively just completely trust all the other entities, and unless it's all backed by the Fed. If the Fed says we have your back, then I think that's a different story. But as of right now, they don't.
I would agree with that. And I would say the best precedent I have for this actually goes back to 2008, because I think that's what happened with Lehman, and then Bears. I think Bear Stearns was the next to fall, if my history is correct. But that's where you basically have banks, or should we say large financial institutions, who are no longer trusting other large financial institutions. Although in this case, it was commercial paper, or I guess it was mortgage-backed securities was the collateral. I suppose that they weren't trusting in that regard, because what these companies were doing, or these financial institutions were doing, is the assets that were moving between them was just mortgage-backed securities. It could be anything.
Well, also treasuries. There just was they thought that mortgage-backed securities were pristine collateral, and they thought that they could not go down in value like the T-bills.
Right.
And I think someday there may be an epiphany moment where T-bills may no longer be pristine collateral. So your example worked fine when you had two banks. If one bank and another bank agree, hey, we don't have to give you the offsetting assets because I trust you. Yeah, that makes sense. But that's only if you're in a two-bank example. If you have hundreds of thousands of banks, then that I don't think that will ever work. Well, let's shrink it down. The mega banks.
Yeah,
the mega banks. There's probably 100 mega banks that have, or I don't know how many banks have accounts with the Fed, and all other banks have to have an account with a bank that has an account with the Fed. So those massive mega banks that have accounts with the Fed, I don't think they all collectively trust each other, or we would have seen the money supply increasing through bank lending, and we are not seeing that. And I'll explain that a little bit further. The banks would lend because they lend. Say I want to take out a loan for $1 million. The bank says, "Okay, I'll give you $1 million." The loan is their asset. Now I have $1 billion worth of liabilities. They don't think They don't. Since we've been in a recession since 2008. They are assuming I am not good for it. And now, if my money's circulating around, if I have to put if I then buy if I then buy a real estate property, my bank now has to take that $1 million and give it to Bank B. And now they don't just give Bank B a liability, they also have to give them an asset, but they're not going to give them a loan as an asset. They have to take reserves or cash from their account and give it to Bank B's account. When they're doing that, now their assets are going down, and my loan is not as trustworthy as it used to be.